Hello friends, today we are going to have a look at various risks involved in international trade and how it is covered in case of doing business in India. When we talk about international trade, it is a very dynamic environment. Along with being dynamic, it is full of risks. When we talk about risks, we need some organization, some intermediary in order to cover those risks. In case of India, in order to cover risk related to export payment, we have the Export Credit Guarantee Corporation Limited. In today's session, we'll have a look at various types of risks involved in international trade, how they are covered, and how is it possible to make the best use of ECGC policies available to us. When we talk about risk in international trade, the first most important thing that we need to do is understand the types of risks involved. When we talk about various types of risks involved in international trade, the most important ones are the industry risk, business risk, risk related to default of contract, risk related to physical damage of the goods, political or country risk, and credit risk. If you all can see, I have highlighted credit risk because that is the one risk which we are going to cover today and talk in detail about. In case of exports, it is very important to understand credit risk. When we talk about credit risk, it is mainly non-realization of payment. The risk involved in non-realization of payment may be through various methods of payment which you must have already covered, like documents against payment, documents against acceptance, LC or open account. In case an exporter exports the goods and services but is unable to realize the payment due to default from the side of the buyer, we say that there is an export credit risk which occurs. Export credit risk may be the risk of insolvency of the buyer, default of the buyer, some fraud which the buyer commits, or even an unwillingness to accept the goods on the part of the buyer. Friends, it is very important for us to understand that unwillingness to accept the goods on the part of the buyer does not mean that he is willing to accept goods which do not conform. When we say conform, it means as per the contract that is there between the exporter and the importer. The risk that we are talking about over here is that despite the goods being in the condition as decided between the buyer and the seller in the sales contract, is not being accepted by the buyer or the importer. Only in that case do we say that there is a risk for the exporter. We cannot cover unwillingness to accept the goods on the part of the buyer due to any kind of non-conformity on the side of the exporter. Most important thing when we talk about export credit risk is the insurance involved. But when we talk about insurance, we need to understand that export insurance is a broad area. Export insurance covers both coverage of goods as well as risk related to payment. The risk related to goods are mainly covered by marine insurance. Whereas when we talk about risks related to payment, there are two. One is related to exchange and the other is related to realization of payment. When we talk about exchange risk, mainly that is covered by various techniques of currency risk management. Whereas when we talk about risk related to non-realization of payment, it is credit insurance which comes into the picture. The main highlight of today's session is the export risk involved and how credit insurance covers that particular risk. When we talk about export credit insurance, it basically means that it is a cover which is being offered by various insurance companies that covers the risk of non-payment in an export transaction. Export credit insurance mainly covers two types of risks: commercial risks and political risk. Almost every country across the world has credit insurance organizations. These organizations are members of an international body called as the International Union of Credit and Investment Insurers, also known as the Bern Union. In case of India, there is an insurance organization for export credit specifically, which has been established under the Ministry of Commerce and Industry and is referred to as the Export Credit Guarantee Corporation of India Limited. In short, we can call it as ECGC. ECGC is an organization which had been set up soon after independence when there were a large number of risks involved in export. In today's world, which is very dynamic, there is still a huge risk involved in exports, and ECGC plays a very important role in coverage of risks in export. When we talk about credit risk covered by ECGC, there are mainly two: commercial risks and political risk. We need to understand these two separately. When we talk about commercial risks, it mainly means insolvency of the buyer, any kind of default from the side of the buyer, or fraud or non acceptance of goods from the side of the buyer. If you see here, I have also mentioned LC opening bank, or bank also becomes insolvent at times. That simply means that ECGC is providing us cover for both exporters as well as banks. It is an agency, it is an organization which is covering risk of payment both for the exporter as well as banks. Coming to political risk. Political risk again can be many in number, but the ones which are covered by ECGC are mainly risk arising due to any kind of wars, any kind of embargoes, any kind of import restrictions. Time and again, import restriction means that DGFT, the apex body which looks into implementing and facilitating trade in the country, at times imposes restrictions on various imports and at times relaxes them. So, political risk can even be considered as changes in the restrictions for import across all countries. India was just an example that I gave you. It will depend upon the country to which we are exporting. Supposingly, there are any changes in restrictions for import in that country, that may also be considered as political risk by ECGC. Whereas there are certain risks which are not covered or not considered as credit risk. These are mainly non-fulfillment of contractual obligation by exporter. That means an exporter cannot claim that there is some kind of risk due to non-realization of payment if he did not fulfill the obligations of the contract, maybe in terms of quantity of the goods, quality of the goods, or any other term, maybe delivery, maybe location, maybe the specifications that had been decided between the buyer and the seller initially. Credit risk will also not cover any kind of default or insolvency of any agent of the exporter or buyer involved. For example, I am an exporter in India and there is an importer in Australia. Both of us hire agents in each of the country. In case the agent of the importer defaults or he becomes insolvent because he was the one who was responsible for accepting the goods there, it will not be considered as credit risk. Similarly, in case there is an agent in India who is an exporter, who is the exporter's agent, and he becomes insolvent or he defaults, it cannot be considered as the risk involved for the exporter. Another type of risk which is not considered as credit risk is failure of the buyer to obtain necessary approvals for imports. When we talk about failure of the buyer to obtain approvals for import, it means maybe there were certain changes in the import restriction and the buyer was not aware of it, and then the goods could not be accepted in the importer country. It will not be considered as credit risk, and ECGC, that is the Export Credit Guarantee Corporation, will not cover this kind of risk involved. Then we can also say that some aspects of the nature of the goods may be hazardous goods, maybe chemicals, maybe pharmaceuticals. If the nature of the goods render it unfulfilling for the buyer, it cannot be considered as credit risk. Even exchange fluctuation risks are not considered as credit risks. That means any kind of exchange rate related fluctuations will be monitored and taken care of through currency risk management techniques and not by ECGC. In case there is any kind of physical loss or damage to the goods, we all now know that it will be covered under marine insurance but not under credit risk. When we talk about principles of credit insurance, that means what are the bases on which ECGC is giving us these export credit insurance covers? They are mainly three. One is good faith. When we say good faith, what does it mean? It simply means that ECGC considers that the exporter is actually giving all the information to ECGC regarding various aspects of the goods. He is not hiding any information from ECGC. Co-insurance simply means that both ECGC as well as the exporter will share the coverage of risk. The exporter has to pay a premium to buy these covers from ECGC, whereas ECGC agrees to cover the risks which may arise due to commercial or political happenings in the importer's country. When we talk about spread of risk, depending upon the covers that ECGC is giving us, depending upon the one which we choose as an exporter, there are certain preconditions as to how much of it should be covered, for how long, what should be the duration, that is, it is spread over a period of time. Two most important things regarding export credit insurance which ECGC takes into consideration is the buyer's assessment and the country's assessment. Every cover which ECGC is providing to us will depend upon who is our buyer and in which country. Depending upon the country and assessment of the buyer, it will fix a limit as to how much risk will be covered depending upon the buyer as well as the country. ECGC has classified countries depending upon the risk involved. There are a few countries which are considered as high risk countries. Export consignments going to these countries might not be given complete coverage, or the percentage of risk coverage by ECGC might be low in these countries as compared to safe or developed countries with which the exporter in India is trading with. If you see here, ECGC provides various covers for exporter. We have various policies or covers, if you see, based on turnover, based on shipment, based on contract. We have policy for services, we have policy for specific buyers, we have policy for consignment exports, we have policy related to exposure, we have policy related to software projects, we have policy related to whether it is a short term or a medium term or a long term contract. We have various types of policies with ECGC is giving to us. All these policies are clearly mentioned on the website of ECGC. These policies have different terms and conditions. If we talk about shipment comprehensive risk policy, it simply means that every shipment that an exporter undertakes, ECGC covers the risk involved per shipment. But if we talk about, say, a contract based policy, in that particular case, the entire term of the contract will be covered by ECGC. Same way, if we talk about small exporters policy, it will be specifically given to certain exporters with a minimum amount of turnover. Depending upon in which area we function and we fulfill, we should apply to ECGC and obtain that cover, which we, after the assessment of the risk involved pertaining to the buyer and the country in which he located, we find as most apt and appropriate. If you talk about export credit insurance for banks, in that particular case, you can simply see that how are banks involved with exporters. A bank is involved with exporters in terms of providing them finance. This finance can be at the pre-shipment stage or at the post-shipment stage. That means a bank is providing certain funds to an exporter for enabling him to export a particular consignment. Once the exporter realizes the payment, then he will repay the bank against the loan which he had taken. But supposingly the exporter defaults, maybe the exporter is unable to pay back to the bank. What option does the bank have? The bank can then go to ECGC based on the policy or the cover which it had taken from ECGC. Please keep in mind that ECGC policies or covers do not automatically apply, or by default you cannot get or obtain an ECGC policy. You have to apply to ECGC in advance to obtain the policy or the cover and then utilize it in case there is any kind of risk involved at a later stage. So same way for the bank, in case there is any kind of risk involved, realization of payment by the bank from the exporter, then they can take ECGC cover or ECGC risk coverage for that, depending upon the type of pre-shipment or post-shipment finance which they had offered to the exporter. With this, we have covered all the risk involved in export specifically related to non-realization of payment and the covers which ECGC provides to us. If you see here, a bank would be willing to lend a large amount of credit to us only if it has some kind of security, some kind of backing from an organization like ECGC. ECGC has been phenomenal in terms of protecting the interest of the buyers. After the completion of this session, all of us would be in a position to understand various types of risks involved in international trade, specifically credit risk, which is related to non-realization of payment due to various reasons, may be attributed to insolvency of the buyer, may be political risks involved, or any other commercial risk involved. We all are now aware that in case of India, we have Export Credit Guarantee Corporation of India Limited, which will provide us a number of covers both for exporters as well as for banks in order to ensure that there is minimal payment risk involved. With this session, I hope all of you have been able to understand that how a claim can be made with ECGC and the procedure documents involved in taking that particular claim. I wish you all the best for all of the sessions coming forth. Thank you.